Why don't you complicate the math for us? Where do you think yields go?
There we go. The crystal ball, right? Look, I tend to think that the Fed is either done or maybe has one more in there, right? I think the more interesting story is I think that rates stay higher for longer. I think the market's a little overzealous on their belief that there's going to be a 100 basis point cut next year. I'm not even convinced there's going to be a cut next year. And I think part of that story is the supply and demand with just the massive amount of debt that the U.S. has. You've gone from $9 trillion in 2007 to $31 trillion. You're going to add $2 trillion more. There have to be buyers for that. And, I think that kind of keeps at least the longer end of the curve, which is more difficult for the Fed to control, to have a floor.
What does it mean for asset allocation? I know that's a very top-level question, but it's a question that not a lot of people understand because, this investment community, we're not used to higher rates. Half of these are very young fund managers,
right? For sure.
Right?
Most of them haven't been down in a higher rate environment.
Yeah.
So the interesting thing on the equity side, if you actually look at companies, I was surprised by this data. If you look at most companies, only 16% actually are hit by interest rates going up, because what happened is most CFOs actually took on longer dated debt at lower, and now they're earning more in the cash. Yeah. So if you net those two out, at least for the next couple of years, they're not going to have that kind of impact. So that's, I think, the good news. I think growth stocks, of course, future earnings have now just gotten more expensive as you could earn 5% on your cash. And so I think that affects multiples and some of the, growth stocks. On the other hand, there's still a massive amount of innovation going on. So I think on the equity market, as I'm obviously a big believer in active management, I think you have to be selective. And I was just looking at the difference today between a Tesla, which is trading at 70 price to earnings, and a GM, which is trading at 4, right? I mean, you look at difference now.
They're not even in the same sector, it seems.
It's crazy, kind of the difference. And so understanding that, and now the Tesla future earnings have just gotten a lot more expensive.
Right.
I think on the fixed income side, I think the good news is because I think we all sort of agree that the Fed is almost done, if not done, and therefore you can start to lock in longer term rates. And, you can be in high yield and earn 9.5%. You can be in private credit if you can withstand the illiquidity premium at, 12.5%, 13.5%. Those are equity returns in the fixed income market. So I think there's some really interesting opportunities, but you have to take into consideration, of where to do it. And then real estate, I think it's going to have an impact. Obviously, we're seeing it already. We're seeing it in housing, where there's very little inventory because people are looking at it. They've got a low interest rate mortgage, and even if they want to move, they look at it now. They're facing an 8% mortgage or something, and they're saying, "I'm going to stay put." And so you see, not a lot of inventory. Having said that, over time, there's no question higher rates will impact the values in housing.
Is this the worst proposition to be in equity markets in years, in your view? With all that being said, because it doesn't seem there's this whole candy shop on the other side, which 13%, that's equity market return if you're willing to do the liquidity premium, for example.
Here we are in HKMA at the conference, and the theme is living with complexity. And one of the stats I just had my team pull together was, if you look, I knew this, and I wanted to remember exactly what the number was. If you missed the 10 best trading days in a 20-year period up to 2022, you miss 57% of your return. Right, of that 20-year period, 10 days, right? And so the problem is you can never time these things. The whole thing about living with complexity is one thing that we know is true. Think about all the events that have happened, the wars that have happened, the pandemic have happened, none of which we would have predicted. And so a diversified portfolio is really, really important. So I think selective equities is a great place to be. And I think, things like here we are in the emerging market region, the China +1 story is a really interesting story. You're seeing countries like Vietnam, Indonesia, India getting the benefit of that. And so, figuring out the right places to invest on the equity side, on the fixed income, whether it's private, I think is important. And then real estate. A lot of people sort of write off real estate with interest rates. Look, I think our view is office probably hasn't even hit a floor. Okay. But, things like logistics are still really positive.
Yeah, I was about to ask you, before we get back into public markets, what do you think about commercial real estate? I see the headlines. They look worrying from this part of the world in the U.S. Should I be worried? Are you worried?
Well, I think there's a couple of dynamics that are important. One is, look at who was the big lenders in the real estate market. It was the regional banks.
Okay.
The regional banks aren't lending there. So, you talk to real estate developers, and it's virtually impossible right now to get a credit to do development. So that's obviously going to impact the markets. And then I think, as I mentioned, I think office, it's hard for anybody to know what office looks like. I think we have I think in New York it's something like a 35% vacancy rate in office, and people are trying to figure out exactly what their strategy should be around that.
Right.
So I think those sector office is going to be a really tough one. I think, as I mentioned on the residential side, sure, higher rates are going to have an impact. On the other hand, there's been a massive underbuilding in the U.S. in residential, so there's going to be a floor to that. And then places like logistics there's tremendous demand. Think about, the data centers supplying and logistics supplying things like Amazon and the e-commerce. I think things like AI and data centers, those are going to continue to expand. So there's opportunities in those types of markets.
Yeah, I would imagine that's going to keep coming up over the next, not just hours and weeks and years. Since we're here, I want to ask you about China. Mm-hmm. There's a massive risk premium that's been built into that market for the better part of the last 18 months. Are you getting more queries in China? Like, based on the people that you talk to, are they warming up at least on the idea? Is there still interest there before they even massively reallocate back? Because that's a different question altogether.
Yeah, I know. I was talking to the head of our Templeton emerging markets team, and he was saying, no, we're back to being interested in China because it's trading so cheap. And if you look at the dynamics in China, so no question, there's issues in areas like property and some of the debt. But on the other hand, it's a market that generates more engineers than anywhere else in the world. It's the second largest economy in the world. Sure, it's not going to have the high single-digit growth that it's had in the last decade, but it's hard. It's 18% of the world's GDP. It's hard to sustain that kind of level of growth. But you have a massive amount of engineers, so great education from that standpoint, and only 40% of their economy is domestic consumer economy, whereas usually that runs at about 60 to 70%. So if they can get their domestic market and the demand there, I think you're going to continue to see some good growth and opportunities. So we think that China's trading pretty cheap.
Is it time to go overweight? That's a big step. Time to look, but is it time to go overweight?
I think it's definitely a time to wade back into China. I'd have to ask the team whether they are ready to overweight or not. I can't answer that question.
Fair enough. Fair enough. What are your plans in China as a business and here in Hong Kong?
So we've been in China for a long time. We have a joint venture in China. We've been trying to, we're hoping to buy out, and because the regulation changed, to own 100% of it. We have a phenomenal team there, both on the equity and fixed income market, and it continues to grow.
How are you looking to, I guess the broadly question in the Asia Pacific and your global footprint too, the way, the investment strategies that you laid out that might do well in the next year or so because interest rates are here to stay at least for a long time. Are you looking to change any of the way that you do your strategies, where your footprints are, what sort of products you're looking to put out there for clients?
Well, so at Franklin Templeton, we're a $1.4 trillion manager. We have clients in 160 countries.
That's quite a bit.
And so, and we cover probably the broadest breadth of both traditional and alternatives management of any asset manager. And so our job is to make sure that we have, whatever our clients are interested, those capabilities and those strategies. We're big believers of feet on the ground, and that's why we operate. I think we have investment feet on the ground at something like 87% of the world's GDP. So it's important for us. Asia is a great region because of the growth. They say there's 1 billion people entering the middle class. 87% in the next decade. 87% are coming out of this region. So it's an important region for us.
Final question. This keeps coming up, and I'm going to ask you this. Private credit alternatives, private market assets. You mentioned alternatives. Is that something that you're deliberately going to push into aggressively? Because that keeps coming up by everyone I talk to here.
Yeah, so I think the interesting story, so we have $78 billion in private credit, Benefit Street Partners in El Centro, so we acquired some private credit capability. And interesting, just let me bring up, we also own Clarion Partners, which is a $82 billion real estate manager. Yeah. Those two groups are talking because because a private credit manager that owns real estate, who ends up owning the property, has to sell it because they can't manage it. We have the teams talking together, the ability to be able to work with each other ultimately to manage any kind of distressed properties. But I think where private credit, people talk about the massive increase in private credit, but actually just take the LBO market. It's actually down from a total number since 2021, but the private credit portion of it has gone from 50% to 85% of deals. So as banks have receded, and I think there's reasons that's happened from a regulatory standpoint, as banks have receded, that's been filled by the private credit managers. I don't think people should read that as, oh, there's a big flood of additional credit available, and so therefore we're going to have issues from an underwriting standpoint. Yeah. It's really just one's replaced the other. And I think a lot of that comes down to some of these capital requirements in banks.